Audio check, audio check. Audio check, audio check.
Yes, I'm here. Audio check. Awesome.
Good morning, ladies and gentlemen. I'll be with you in just a moment. From the DYOR Media Network, we're coming to you live on the DYOR Media channel. Today is August. I'm going to look again, August 23rd, 2023. And as I always say, I got to look because this year is flying by. This month is flying by, and this week is flying by. It's already Wednesday, and I can't even believe it. Got a good show for you today. Not one that everyone likes to talk about, but it's one that everyone has to deal with. And I'm coming to you today from Canada, but I'm based in the U.S. Our guest is based in the U.S. today. Well, he's always based in the U.S. But it doesn't matter what country you are in. This topic today is of an utmost importance because, as I said in the body of this, it can set the stage for your success in your investing career, or it can doom you to fines and penalties forever. But before we get to our guest today, we're going to talk a little bit about the news of the day. And the news of the day is that my crypto chart analyst, Pedro, is not here today. Pedro's been on a roll, ladies and gentlemen. He has been on a roll, basically calling the market. I shouldn't say, as he likes to tell me, he doesn't call the market. He reads the charts and tells us what the charts are telling us. And from a technical point of view, he's been right a lot lately. He called this big down. He called it going up to BTC going up to 30,000 a couple of weeks ago, and then it consolidating for a while. And then he said, it's going to drop down to about $23,000, right about when it did. And I didn't listen to him. You know, you can always play the futures markets, but what's the best way to lose all your money? Right, in the futures markets. And if you've Telegram and elsewhere that when they're talking about selling a project, it shows a scene from the movie Trading Places when everyone turns to Eddie Murphy and Dan Aykroyd and yells, "Sell!" That's right where I used to work. And they filmed that movie 1 year before I worked there. And a lot of the guys I worked with were in that movie. And I can still see them, and I remember them at that age. Anyway, let me... for some reason, my desktop capture isn't working. Where is my desktop capture? Well, Patrick, I know you're in the background, and it wouldn't be a Striking Balls show without just a little technical snafu. I'm going to fix it right now, as they say. And it didn't come up. Anyway, I had the news up on my screen behind me. It wasn't going to work. Anyway, what I wanted to talk about this morning was one of the things that my viewers tend to be invested in because they're new. Like I like to tell everybody, this show is kind of geared as more higher level. It's not meant for the day trader and the people that are really down in the weeds in the crypto. And that type of stuff. It's meant for the new people. That's why it's called DYOR Live, because we want to teach you how to do your own research so you don't. But one of the things that people tend to get involved in early on is in the Binance chain and the Binance Smart Chain and investing in BNB because the gas fees are cheap. They understand it. And there's a lot of promotion and scams in it, so you get sucked into it. But so there's a lot of people that watch the show that are invested in BNB, a lot of projects. And it's been taking a tanking lately. Yesterday, it dropped in some exchanges. It dropped under $200. And I had this great chart. It's going to come up here on my screen, and it's not for some reason. And it dropped under $200. And that's not a good thing for BNB because a lot of the projects, a lot of the money in crypto is in what's called liquidity pools. And liquidity pools... for a lot of projects on the Binance Smart Chain, their BNB is paired with their tokens. And when BNB goes down, the value of their liquidity pool goes down. When the value of their token goes down, it's not linear. It's like, it's not exponential. It's just some kind of drop off in math that I don't know the exact one. I'm just trying to find my, see if I can call this back up. Nope, not working. Anyway, and so the BNB hasn't been doing anybody any favors lately, and Binance, and really it's just because of a loss of faith in Binance. There's nothing really else to describe it. Binance as a company is doing well. I mean, they do have an overexposure to the value of their company and the BNB token. We get that. But they're still 40% of the market in exchange trading and that type of stuff. So they're still huge. And all they need to do is get a couple of regulatory wins and they'll be back on track. But in the meantime, divest yourself of BNB projects. Anticipating it to get as low as $100 on BNB, and maybe we'll have some tax losses that Patrick can talk about. Anyway, before I get too far into this, I like to talk about my sponsor, Audit Chain. Audit Chain, if you haven't paid attention to me over the past couple of months talking about them, first of all, I thank them for being the overall sponsor for my channel. As I say, all the original programming on the DYOR network, including this show, Rugged, Ruined, and Wrecked, Crypto Chit Chats, and a couple other little ones we do here and there, are sponsored by Audit Chain, and we thank you for that. What Audit Chain does is they have software validating nodes on the blockchain, and they have a software package that goes into companies. You don't have to use both projects, but their validating nodes can go in and check SEC filings in a matter of 2 minutes, and you can see where all the auditors, the big four, made mistakes. And Patrick, I know you're listening in the background. I'd love to show it to you because it's basically free at this point. But you can literally, and I was, one of our best episodes is someone said, hey, why don't you do Tesla online? And so I had Jason from Audit Chain do Tesla. I ran their SEC filings. And it came back with all sorts of errors that their internal accounting or audit committee missed, their external auditors missed, their CFO missed, and of course the SEC missed. The SEC is not going to check anything, but they missed disclosures. They had their balance sheet didn't balance. Kind of a basic, it's called a balance sheet, right? Balance sheet didn't balance. We did another one that was a bank. Their balance sheet was off by $15 billion. Now, I didn't say million, it's billion. Anyway, I'm going to stop blathering, so I'll let you listen to me.
About transparency, and many groups out there are trying to solve that, but Audit Chain has already done that. Audit Chain's protocols and network of validators can mathematically prove that a company's entire financial state, not just proof of reserves, but a proof of state, and whether or not that company is providing accurate reporting and information to the respective government regulators and to the public. Seriously, you and I can check crypto companies and traditional companies' financial reports for transparency and accuracy using a logic and reasoning engine called Patrick that records its output where? On the blockchain. Seriously, ladies and gentlemen, blockchain technology is now able to be used to check on traditional companies. Behind me is a list of companies that comprise the S&P 500, S&P 100. In essence, the largest U.S. companies by size. More than one quarter, 29 out of 100, have problems with their reports. Remember, accounting and other corporate systems are garbage in and garbage out. So if there are problems with the data out for these companies, in red here, what does that mean? That's right, ladies and gentlemen. There are problems with the data going in. And this was figured out not by accounting or auditing firms and fleets of consultants. This was compiled and reported on by Audit Chain's Patrick validating nodes and took only 5 minutes. It's revolutionary and it's a disruptor technology. Audit Chain.
All right, ladies and gentlemen, you heard me talk enough about Audit Chain, but thank you to Jason Myers at Audit Chain and the entire crew at the Descartes Alliance and everything about that. But let's get to the point here of the show. The show today is about tax, and I've been watching, as we say on LinkedIn, now that all you have to do is connect to someone and chat with them once or twice, and they're your friend. But my friend Patrick here talk about tax. And he started his own show on it, and when I first saw him start, viewership, like at all of our shows when they're low, including this one now, is the viewership isn't great, but when you have good content, your viewership comes. And I saw the viewership going up for Patrick because people want to learn about tax. They want to make sure they're doing things right. There's plenty of people out there saying, it's crypto, I don't have to pay tax, and I'm routing it through Malta and around the Cayman Islands, and no one's going to find me. They'll find you. But that's not the point. The point is that people want to learn about that, and good content is good content, and that wins in this game of getting the word out and getting, if you're a business, getting good customers to come in because they want to learn and they want to do things right. So I'm going to bring on Patrick Camuso of Camuso CPA here. Patrick, welcome to the show.
Thanks for having me on. I appreciate it.
You're welcome, Patrick. I've got you, as I say here. I bring everybody on the TV here so I can say that people sat in they're on my TV in my living room, and we have a little chat for a minute here. Give us the 1 minute spiel. So we want to get into the heart of the matter today, but give us the 1 minute spiel about how you got into accounting and started your own firm.
Sure. Well, I basically have been in accounting for most of my adult life. I started in my late teenage years in the Big Four, worked there for about 6 years, and then I started my own firm. I've always been focused specifically within tax and accounting on the investment management space. So before I started my own firm, I was working with a lot of private equity, hedge fund, mutual fund companies, working with large unstructured treatment too, and then create accounting systems and tax preparation processes. So that's some of my background. I got involved with Bitcoin and crypto fairly early on and have been consulting through my firm at Camuso CPA to investors as well as businesses since 2016. So I've been in this space for a while and very focused on it. And back then it was really just like Bitcoin and Ethereum, mostly accounting for that. And then, we started to see ICOs, the proliferation of multiple blockchains, then DeFi, then NFTs, now Web3. So through each cycle, through each stage, the learning curve for a crypto CPA just continues to expand, and I've just been growing with it.
Well, that's good. I can say from personal experience, I've used I'm associated with a particular tax platform. And they're based on having a general system, but lots of plugins that go into it. And I was always waiting for a decent crypto plugin and it only just recently came in order to properly bring crypto, wallet accounting into the system. Meanwhile, people were clamoring for it for ages. I mean, literally ages. And so, we had to do workarounds and put it on as an asset and inventory, and then keep changing the price on it and this type of stuff. And even with the new the plugin that came was still. I mean, I thought the person that programmed it was just said, I can make some money doing this. I may not be good at it, and so as a result, the rest of us are stuck with a crappy plugin on it. But the fact that you started your own company and you focus, one of your focuses is on crypto, is rare. It's very rare because the larger firms have a little, one guy in the corner. They're like, yeah, he understands it. Go talk to Jim down there. And a lot of the smaller firms, the people have never been exposed to it, so they don't have any good advice. They're like, well, let's go online and see, and then they get into all sorts of mistakes and all that. But let's get into some good things here today. Patrick, what are things in crypto that are taxable that people may not think are taxable and are not ready for?
Well, honestly, there's a lot we can hit on in that because there's a large sort of knowledge gap with people when it comes to taxes. I still find it hard to believe, but there's people that still want to argue about just paying crypto taxes in general, even though most of their transactions are taking place on a public immutable ledger. But putting that aside, something that I've been focused on much more deeply over the past year that I see as an emerging tax issue in the digital asset industry is sales taxes. This almost feels like what crypto taxes was back in 2016 timeframe. It almost feels like that's what NFT sales taxes are now. And the reason why I think they're similar is because most of the industry isn't even aware that this tax is an imposition on them.
Right.
And the
Right.
tax advisors aren't aware of it. There's almost no technology solutions for it. So currently, right now, from what I see industry-wide, this is something that's going overlooked. And we've already seen many states, such as Washington State, give guidance stating that if you're selling NFTs, in many cases, they're going to be taxable for sales taxes, and those taxes could also be applied retroactively, meaning that if you're a marketplace or if you're an NFT artist that's excuse me, that has been selling NFTs over the past years, you could still tax risk associated with this.
Well, I think there's to make sure the viewers understand, there's the buyer and seller, there's the issuer of the NFTs, and then there's a buyer and seller of them. And the issuer, I'll use since I'm in Canada, I'll use a Canada example. Canada, specifically Ontario, we have a 13% HST tax, a harmonized sales tax, and you don't need to pay that if you're doing business and your revenues are under $30,000. It's just not worth the collection fee. They're like, wait till you get over 30,000, and then you need to pay it. If you're trading, or first of all, if you're issuing NFTs, you almost automatically get more than $30,000. Couple of ETH, and boom, you're over $30,000. And that's a business, whether you're a sole proprietor or you have a business, and you got to pay sales tax on it. And if you're the user, if you're buying the NFT and you're day trading it, the government's going to consider that a business. And if you're buying and selling them and buy and sell a collection of over $30,000, they're going to want their HST tax. And nobody's talking about it here in Canada. But like if you're the little coffee vendor on the side of the street just selling from a little truck, and as soon as you hit $30,001, they're like, agents swarm over you. They're like, you got to pay your tax. But they're not there yet in the awareness for the NFT tax. And there's a lot of people. I know you've watched it, and you've probably consulted with a lot of people. But I've watched it. Just that whole business of OpenSea. You think that's just one giant IRS and CRA audit waiting to happen? Send us all your user subpoena. Give us all your users. All the wallets. We all know the IRS famously bought too many licenses to track down Russian money. And so if they have too many of them, that means they have thousands of agents analyzing the blockchain, and they'll get you. But so NFTs are an area that people really aren't paying attention to. But you brought up something on LinkedIn the other day that I found to be it was something I didn't realize because it came about on us really quickly out of nowhere, this Friend.Tech thing. And you put a poll up on it and a question about it. Tell us more about your thoughts about Friend.Tech.
Yeah, so obviously Friend.Tech is very early stage. I haven't personally had an opportunity to really experiment on the platform yet. I certainly plan to. So I want to even myself get more into the weeds on it. But I believe that there's going to be taxable events that take place when users are transacting on that platform, because it is crypto native and they are on-chain transactions where you're going to see users are actually selling shares up to their followers, and those followers can resell those shares. So there's many potential tax implications that can come of that for the individual purchasing the shares of the profile. If that transaction is done in a digital asset, there's likely going to be a capital gains event there. On the side for the person that is selling the shares, when they receive those digital assets as a form of payment, that's going to be an income tax event. And we also want to track their basis in those assets that they're holding, because then that also can trigger a capital gains transaction for them down the road when they sell that. So when you're making these transactions, taxes almost always become an afterthought. It's something I see with each cycle, new asset classes, and then they come to me sometimes a year later, and they realize, oh man, I have to figure out all of these tax ramifications. So yeah, I was posting about that yesterday, basically trying to warn people that there are going to be tax implications. It is something you should be discussing with your CPA or your tax advisor, and understanding what are the tax implications and what are your accounting requirements to make sure that you're planning ahead for tax purposes. You're not triggering taxable events where you're not anticipating them. And also you're not left in a scenario where you're scrambling around to get your accounting records at the end of the year.
I mean, even before crypto, there was plenty of scrambling going on, you know?
Oh, yeah.
Hey, here's my shoebox of receipts. And you're like, no,
Yeah.
no. Thankfully, while I'm affiliated with an accounting program, I'm not a practicing accountant or by any means, but I do it for small business consulting to make sure companies get up and running. And what I tell people, and I'm telling this analogy because it applies to crypto too. As soon as, if you're thinking of starting a business, whether it's crypto or regular, selling shoes on the street, whatever, as soon as you think about starting that business, get a bookkeeper to start keeping track of your expenses. Because all of those expenses can be written off later, and you have a history of officially starting your books when you started your business. So you can go, sometimes, when I did a lot of government bidding, they required 2 years of financials. Didn't say profitable financials. They just want 2 years of financials so they know you're somewhat legitimate. Start them. Who cares
so they
if
know
you have
your
losses?
business even exists. They got to see, they have to have something to go off of.
Right.
So I think that's a great point.
Hold on. He'll come back here. Up.
After thought.
Hey, hold on, Patrick. The last, right from when you said that's a good point, you froze and your image came out, but you're
Sure,
back.
no problem. I'll start over. But what I was saying was that is a good point because, there's a lot of conflicting information if you look at crypto taxes online, and it leaves a lot of people sort of on their heels. You can go online, you can see some Anon Twitter account telling you don't have to file taxes. Someone says staking is taxable upon receipt. Someone says it's taxable when you sell. And, what I see happen a lot of times is even today, there's people still coming to my firm for us to prepare their taxes going back as far as, 2016, 2017 in some cases, where they've just neglected their accounting for years. And if one of those people are out there, we will accommodate you and we will, be able to handle this for you, and you're not alone. But it's not a position you want to get in when you're going back far in your taxes. You're going to have compliance issues. It makes the accounting more difficult, and that all usually ends up negatively impacting you as a taxpayer, although we want to mitigate it as much as possible. So staying on top of your taxes on a yearly basis, and that's really what we help people get into compliance with. And then we try to get them on a more proactive track of keeping things updated, maybe on a monthly, quarterly, bi-yearly basis, depending on your activity, because staying on top of this actually yields opportunities, because then we can start seeing, are there loss harvesting opportunities for you? Do you have estimated tax payments coming up? Are there considerations around certain assets that you're selling and the holding periods assigned to them? So all of that and all of your business decision making, like you said, is really contingent on just having your accounting done in a basic set of financial statements.
Let's try and focus on trading from one wallet while you're getting new at this. Don't start 49,000 wallets and send money back and forth. A lot of people got in trouble with that early on because it was impossible to keep track of things. You'd buy things in one wallet, transfer it all around the internet, lose tax on tokenomics, and then sell it in another one, and then what's your cost basis? God.
It's very common, especially when someone comes to the firm and they're sort of newer in the space. I would say that's when they have a larger amount of activity in many cases, because they're sort of bridging a learning gap, right? So that's when you said they'll come with many wallets, many blockchains, usually a higher volume of transactions. And I do think that over time, they start to find their place within the market. They find their investment style. They get a deeper understanding. And then I usually see the portfolios start to become consolidated and more streamlined, which absolutely is better from a tax and accounting perspective. So yeah, that is a common trend I see, is that, there's always moving pieces for everyone, right? Even if it's been around for years. But I do see like there's a lot of more random transactions for people starting off, and then they start to say, okay, this is what my portfolio actually should look like, and this is what we're looking to do.
Well, we've all got the background noises here. I've got Mrs. Striking making the noise, and you've got other what's going on there too. But you're exactly right. I put a comments out there. I put some comments out there for if there's any questions for Patrick right now. Let me know. Patrick, I've got you off the screen while you take care of what you need to there. I can't stress to everybody how important Patrick's topics are here, and pay attention to them on LinkedIn. I do want to say thank you to those watching on LinkedIn. I really appreciate it. We've been live on Twitter today too, and we've been trying. Twitter brought that back. Unbelievably, they brought it back, and I wonder if they're actually. And it's not in our timeline. Live talking about tax. I'm going to do a tweet here. If anyone gets it, respond to it. Live talking about tax. I can't even write it right. So we're to Patrick. I see you're coming back here.
Sorry about that.
No, that's all right. Hold on one sec, everybody. I'm just sending a tweet out. Live talking about tax with Camuso. CPA. Twitter has brought back, or I should say X has brought back their live streaming. And it's not working well yet. Elon brought it back, and it's okay, as they say. Anyway, Patrick is back here on the screen.
Sorry about that.
Let's see about that. That's all right. As I was saying, any questions for Patrick? Now is the time to ask. I did have when putting this together the other day, I was talking to someone about it, and they left me a question that I thought before. But if someone has not done their crypto accounting correctly, and it's been like they say, "Wow, I didn't account for my 2015 Bitcoin winnings." What's the window that they need to go back and file amended returns to fix that? I mean, people argue about this all the time. There's what you should do and what you have to do. What's your advice on how far back people need to do that?
It's, there's multiple considerations within that question. For most scenarios, the statute of limitations is going to be 3 years. If we get into fraud, it could extend in past that. So, somewhat it depends on what is the level of over-reporting in terms of, how far back we're going to want to go with amending tax returns.
Right.
It is very common where people sometimes just totally don't file them because of this issue, which is surprising, but it's very common. But there's an accounting consideration as well, because the tracking of your cost basis is a cumulative process, meaning if you purchased a Bitcoin back in 2015 and then maybe you purchased another in 2016, and you've just been making purchases from there, and you have all these different tax lots of Bitcoin that you purchased over the years, they're going to have different dates that they were purchased. They're going to have different fair market values that they were purchased at. And that all needs to be accounted for appropriately. Or when you do sell those in the future, we're not going to have the cost basis information and the holding period information to apply to that, which can largely impact the taxes, whether we're talking about just picking up the cost basis to reduce the proceeds or have it be treated as a long-term capital gain versus a short-term capital gain. They've been neglecting things. The first step is really to just do the accounting and get the accounting done correctly from your very first transaction through your very last transaction.
Oof.
And, we do this on a tax year by tax year basis, because then
Right.
it gives us a clear picture. This is what we're calculating that you owe for taxes each year. Then the next step that we take is look at your tax filings, and then we can start to make a compliance plan
Right.
and implement that in terms of, these are the years where there are large discrepancies that we should amend, versus maybe, if what you reported and what we calculated is an immaterial difference, then we may just forgo the amendment. But still, doing that accounting was important to get that cumulative cost basis.
Well, I think what you're right on track when you're saying let's get the accounting done first, and it's not just in crypto. That's any business. I mean, that's any business at all. Get your accounting done right, and that doesn't mean only get a CPA to make sure everything is right. That means starting just getting your books running correctly. And of course, a CPA can get you started right. That doesn't mean that you need to pay a CPA to do your books every day and make sure everything's right. They need to set your company up correctly, get your chart of accounts running right, make sure there's someone in the bookkeeping chain that can just record things correctly, and then they get to oversee it and make sure it's right. And that's any industry. But because crypto has extra eyeballs on it, and there's lots of conflicting information, it's extra important that you get started correctly. But we do have a question from the crowd here. You've kind of answered it already, but I'll ask it for Nitzer General. Do taxes, or are there any situations in which unrealized gains could be taxed in crypto that you're aware of, Patrick?
Currently, in most scenarios, I wouldn't expect unrealized gains to be taxed. There could be changes to that in the future, especially for certain people if they elect a trader status and they mark to market. Right now, though, that doesn't really apply now.
Right. God, if they do start doing, I mean, there's plenty of proposals out of Washington D.C.
Oh yeah, there's certainly proposals. People
say, we're just going to unrealized gains. We're just going to tax the wealthy. We're going to create a seller's market by just selling.
I think even a bigger one is them going after the wash sales.
Yeah.
Which is a huge tax benefit to people.
That's a valid. At least that's a valid point. Trying to get people from just gaming the system versus stealing their wealth.
Well, right now they only apply it to security, so they can do it with property. There are economic substance rules within the tax code that are try to basically make sure that the transactions that are taking place are legitimate. I think it's tough for the IRS to make an economic substance argument against a wash sale, just due to the nature of the crypto industry itself, being that an asset price can drop 50% within a day. It's
right.
A hard argument to make that there's not economic substance to trades that happen within a short time frame. But yeah, if they take wash sales off the table, that's a big tool that'll be sort of getting pulled away from a lot of people, and it also will increase their accounting complexity as well. I used to do a lot of wash sales analysis back when I was in the Big Four before I started my own firm. So I could, kind of anticipate what that'll look like. And it'll just be an extra step on the whole accounting process, to where anytime we see someone booking a loss, then we would have to apply a tax adjustment to that. So I'm
They'll get you
watching that closely.
All right, Patrick. We covered a lot of topics, but to summarize, let's make sure you keep your life simple. Try to trade from, if you're doing a lot of day trading, a lot of products, try to keep buys and sells in the same wallet so you can track it easily. But one of the things that I like to finish up with, not just going over what we know or things to watch out for in my shows, is down the road. With the imagine that Friend.Tech, let's just go along the hypothetical line. Imagine every transaction in Friend.Tech is a capital gain. Every time someone posts something or sells their shares of Friends or something back and forth and that kind of stuff. I mean, there's a value increasing, so obviously if there's a value increasing, there's going to be income or losses if it's going down. But it could turn out to be hundreds of millions of transactions a day if this thing blows up through Asia and all this type of stuff. It's simply something to overwhelm taxpayers and tax preparers and the tax authorities. How do we reconcile the fact that capital gains taxes were originally developed for low volume trading? Like, well, we bought $100 million worth of GM and then we sold it 4 years later. And now you could potentially have, if you use a bot, you could have a couple thousand capital gains transactions a day. That policy needs to be changed. From your eye in the accounting community, what's the way to change that so it's not such a burden on the whole industry?
Well, it's tough. I'm in the weeds of at Camuso CPA, that are trading algorithmically can have up to 50 to 100 million trades a year, believe it or not. So we're dealing with some of the highest volume, that's out there. It's all just back to the fact that crypto is taxed as property, and that makes each trade a taxable event. I think that's going to be something that's unlikely to get changed with the IRS. It's been pretty long standing that it's going to be taxed as property unless they develop a whole new taxation structure for it and look at it as a separate asset class,
right,
which I think may be better, but doesn't appear to be the trend to me. So, for as long as it's taxed as property, I think we're going to have to basically address these issues with the volume. I think crypto itself is unique because it's like the whole, just business people, individuals in general are getting involved now in a financial system where a lot of times you would see like this volume of transactions happening more with more like sophisticated types of like investment funds and stuff like that. So is the volume, and is that going to change? I don't necessarily think that it will, because then, like going back to that wash sales conversation, I see the complexity of this increasing to where not only is every trade going to be taxable, but then we're going to have to analyze them for wash sale purposes. And then the NFTs that we're accounting for, we may have to start looking through and, having them be taxed differently based off of the underlying nature of what that NFT represents. So I don't really see the complexity decreasing. In fact, I anticipate that it's probably going to be increasing in the future, in my opinion.
Oh.
I hate to say that, but I see it coming.
What's your website? CamusoCPA.com?
Yep, my website's CamusoCPA.com. I post a bunch of content on there, including blogs, longer reports. So there's a lot of good resources on there for people.
Everybody, you got to reach out to Patrick. Don't reach him out all at once. He's not that big of an operation, but he's growing. He talks about hiring people and that type of stuff. So I know my 20,000 viewers on each platform will all contact you today. Okay. Actually, there's about 40 in all the different platforms. But anyway, Patrick, thank you for stopping by today. I really appreciate it. I hope this is just one conversation we have of many over the months to come about tax as more people get into crypto. For those of you watching, wherever you're watching it in the various platforms today, I'll put links to his website where you can contact him. But the best way to find him is on LinkedIn. He's very active on LinkedIn with his shows. He's also very active on YouTube with his shorts explaining topics and all that. And it's good to have someone in his business being a creator, because there's not a lot of them. There's not a lot of them. But anyway, thanks for watching. Mike, thank you for watching. I hope you're watching on the big screen in the living room right now. Pit Monk, thank you also for watching. Appreciate it. And to the rest of you that have dropped comments, thank you very much. I didn't get them all on the screen, just the relevant ones. And I unfortunately left the spam ones off too. But Patrick, thanks for coming. I really appreciate it. Have a great day, and we will talk to you soon.
I appreciate it. Thanks a lot.
All right, everybody. That was Patrick Camuso of Camuso CPA. As I said, Pedro is out today, so we're not going to have a market discussion. We'll probably have that tomorrow, but that's all I got for you today. Tomorrow, we've got my interview from the blockchain CX, Virgo Exchange. They're an exchange based in Toronto, expanding into Australia and Hong Kong. And they are starting to move just away from trading cryptos into being ready for real world assets. And you've heard me talk about real world assets a lot. And it's because the market is so big for them. The potential market is very large for them. In fact, I'm hosting a podcast for Five Goats Marketing Company, and I'll put links to that about. But if you search LinkedIn and I think Twitter too for Five Goats, I interviewed the CEO of Materium, Vinay Gupta, about their passport that brings the real world liabilities, warranties, title, and everything about purchasing a home or a property, and brings it onto the blockchain. Way more complicated than that statement, but it does allow the buyer and the seller to just do a 3-click transaction to buy that property, which is amazing. It's amazing. You can do it. It's not coming. It's live now. It's amazing. But anyway, that's all I got for you today. My name is Tom, otherwise known as Striking here in the digital media world. We're so glad that another episode of DYOR Live is come and gone, and there'll be more. Like I said, I'll see you tomorrow. So be there.